as well. Rajiv Batra is now with us. He's head of Asia Pacific ex-Japan China equity strategy and head of India and Southeast Asia equity strategy with JPMorgan. Rajiv, good morning. Good to have you here. Prashant this side. You have a real sense of what foreign investors are doing of all sorts. You know, the fast money, the long onlys. What's the view? I just want to know, Rajiv, about after all of the selling that we've seen over the last 1.5, 2 months or so, are we now at the fag end of that episode? It's been one of the largest episodes of foreign selling ever in a compressed time frame. So where does that stand?
No, thanks for having me today. I'll say the conversation have now started changing versus what it was a month, 2 month, or a 3 month back. Investors are now looking for ideas because some places even value has started emerging, and global investors, particularly in the western part of the world, are largely focused on a value, which India was missing for a good amount of time. But now when we look into the financial space, some of the auto space, utility space, value has started emerging, and hence people have started drawing their shopping list. But we have not seen the full arrival yet because primary market in India is quite buoyant, and all major focus is going in primary market only. If you look at year-to-date flows, secondary market suffered 14 billion outflow, primary market seen 12 billion outflow, net still 2 billion outflow. But I will say that some interest have started coming back, but the full arrival, I'll say, will take earnings or a GDP print or even the high frequency data moving a little bit on our side. The only clarity they have now got is that policy continuity will happen in India post Haryana and Maharashtra election result. So that gives some breathing space to India now.
Rajiv, hi, morning. On the growth slowdown here in India, I just want to understand, is this becoming a bigger concern for a lot of the global investors you speak with? Or are they seeing this as maybe a one-off, a passing phase because we had elections and we had monsoons? Just want to know what they're thinking right now and how concerned they are about the GDP print, the earnings slowdown.
Yeah, Surabhi, it's a massive concern because if you look at the factor performances in India, earnings momentum or the earnings resilience, in good time earnings momentum, in bad time earnings resilience has been what driving the market overall. So last 3 quarters in a row, as you can see, deceleration in earning growth on YOY terms that has started concerning investors. And when all the plugs got pulled off, when we saw in the second quarter FY25, Nifty 50 exponential or MSCI India exponential delivered negative earning growth for you on a YOY term. So now that's the reason why, even if they are a bit clear about that India is not crowded position, policy continuity is not an issue, what is making them wait on the sideline is they want to see high frequency data which start showing that green shoots are emerging and slowdown is not a concern. We do believe that what we saw last quarter, at least in GDP growth term through, or even in earning growth term through, we were at a trough level. As a house call, we believe second half fiscal year FY25 growth will mean revert to 6.7%. That's the house call. And in terms of earnings also, we believe led by strong government spending, better farm income due to the kind of acreages we are seeing in Kharif or sowing on the Rabi side, and lastly, some discretionary spending due to decent festive season and the wedding season, which is ongoing, will bring earning and GDP growth back on the radar.
All right. Hi, Rajiv. Good morning and good to see you. Well, that's heartening to hear, right? That the second half of the year is going to be better. But we're clearly not going to get the earnings that we started this fiscal year at. So given that earnings growth will be a little bit tempered in comparison to what we're working with, do you think there's a case for the PE as well to see a bit of a de-rating? The earnings pullback has happened, earnings cut. But India was getting a premium because we were going to be growing at such a fast clip. Or do you think it's par for the course and FY26 we get back to our growing whales? So the multiple stays.
So, Nigel, if we look at the valuations as well as the market performance, the recent correction which large cap index saw, 12% when we do the dissection of return, close to 6 to 7% came in form of P de-rating, and another 4 to 5% came out of from the earnings downward revision. Now, start of this fiscal year, everybody had high hopes on India, 18% earning growth expectation. But now when we look at a picture, the sell side has become so cautious on India. The earning growth expectation for entire FY25 is 8% only. Although they are putting a lot of pressure on 2026 by forecasting 19% earning growth. So I believe near-term basis, next 6 months, there is a potential of getting an upward revision. But for 2026 or calendar year 2025, that's where some downward revision or reality checks to hit. So when we are coming up with our index target of 26,500 on Nifty, our earning growth forecast is premised on 11% in line with the nominal GDP growth of country rather than consensus sitting at 19%. But in terms of a PE2, we don't think there is a big chance of a derating from here on because policy continuity happening and geopolitical risk premia getting lower and lower because this is the third term of Narendra Modi government and geopolitical relationship is still getting better and better with time. Even some kind of an amendments happening in relationship with the neighboring country China too. That means our risk premia can decline further from here. How lower? Remember back in 2021, 2022, India risk premium was only 1.5%. Right now we are at a 3%. So we are not calling one to arrive, but if it keep on decelerating lower, we can even trade at 24, 25.
Got it. Rajiv, so, you've got so much global perspectives from your team around the world. What's the implication of Trump in the US for India? General consensus is he's going to be good for a market like India. But, I mean, we all know about consensus, right? Is it going to help at the margin? Could it hurt? What's your sense?
So our baseline scenario is emerging markets will suffer overall because our base case view is that Trump arrival means 60% tariff announcement on China during February and March and implementation by second and third quarter. Due to this, we have brought down the China GDP growth forecast to 3.9%. And that has impacted even the country that are dependent on China, where for emerging market, our GDP growth revised down from 4.1% to 3.4%. Massive cut over there. The economy like India, US, and few other who are not directly linked to China, that's where we are seeing zero impact on the GDP growth term through. In fact, it is positive for India because China being the large commodity exporter, and tomorrow if China growth goes down, commodity prices getting lower will be good news for India, Indian corporates, and even for the margins also. Because remember, India earnings story came under question mark when the margin started dwindling due to the higher commodity prices. If commodity prices goes down, India feel better. And most importantly, India still trying their level best to be the part of the secure sourcing theme of the US, where India can become part of first America, or you can say US plus one kind of a supply chain.
Okay. So, Rajiv, I mean, kind of summing it up for our viewers, what you're saying is that the street is still penciling in some 19% earnings growth when you're at around 8% this year. So the gap is too much. Somewhere there will have to be a reality check. But at the same time, you're not overly bearish on India either. You're expecting things to get better in the next calendar year. So now tell us, then all these fence sitters, all these global investors that you're speaking with who are expecting improvement in earnings, what are you telling them? What's the portfolio call right now that you're going with for India if someone's taking that medium-term view?
No, so it will be a very, so it will be very year or 4 years maybe difficult in making for emerging market because think about the ecosystem we are getting into. Strong dollar, higher rates or high rates overall, and then all this trade tariff or trade uncertainty related kind of a correction per se. So in this kind of an anemic growth environment for EM, anyone who can give a sustainable or a resilient earning growth, that country is going to command a premium. So when we look at our Asia allocation, what we are advising client in terms of pecking order, number one country on radar should be India, number two should be Taiwan, number three should be China, Hong Kong, and then our two underweights, number four is Korea, and last one is ASEAN. So that's what we are recommending. Within India, we had a barbell, or you can say a pro-defensive approach when I came last time on your channel. But we dropped the barbell approach 3 weeks back. We totally turned risk on. And we are saying if you want to play India, looking at the policy continuity, GDP uptake, growth upside coming up over there, cyclicals is a way to approach. Within cyclicals also, we are recommending to be overweight on industrials, financials, real estate, hospitals. In terms of consumers, we are much more selective. And what we are funding it through by being underweight on materials where you will have the pressure of commodity prices going down and some dumping from China, and the four-wheeler passenger vehicle play and the OEMs. That's what our underweights are.
Okay, so that was a lot to take in. Just quickly reiterating, your overweights are industrials, financials, and hospitals. These are the three biggest overweights, right?
Yes, and real estate, 4.
And real estate. So 4 top overweights. And you said India is your number 1 pick in Asia, followed by which other 2 markets? So Asia and emerging markets. India is the top pick. Who's number 2 and number 3?
Number 2 is Taiwan as an overweight.
Okay.
And outside of Asia, it is Mexico and UAE.
Okay.
All right. What about positioning in the Indian markets? If you're going to see a big recovery, do you expect the broader markets to do better? Because they got hit harder.
Definitely, Nigel. Overall market will benefit, but at the same point of time, because of a higher beta and not requiring too much amount of liquidity, small and mid cap can also rally harder. Last week, we closed our underweight or a bearish call on mid and small cap also, because we believe if the large cap do well, at 1.5 times or 2x kind of a speed, even mid and small cap will also make a comeback. Again, there is a window right now to make a money for people. It will be a front-ended return year where majority amount of a return you will make start of the year itself only. But as you go into middle part of the year where tariffs are being announced, tariffs are being implemented, and suddenly the volatility and risk premium goes higher in the market, then even best of the markets may start going on the sideline. And investors, particularly global asset allocator, may start looking at safer asset classes like bond, money market to deploy money. In that, even India can go on the sideline. But initially, when it's time to make money, I think that's the right time we are approaching now.
Rajiv, great conversation. Thank you very much, and come back often because there's a lot to talk and lots changing very fast enough as well.